You've probably heard the saying, don't put all your eggs in one basket. But what does it actually mean when it comes to investing? Welcome back to the Industry Portal's Finance Explainer series, where learning finance is made simple. In this video, we're diving into one of the most important principles in investing, diversification. But what does diversification really mean when it comes to investing? And how can it help you build stronger, more stable portfolios? By the end of this video, you'll know exactly what diversification is, why it matters, and how to start applying it to your own investments. So let's dive in. Okay, so let's start with the basics. Diversification is the process of spreading your investments across different assets to reduce risk. The idea is simple. If one investment performs badly, the others can help balance out the losses, so your overall portfolio doesn't take a big hit. So here's a quick example. Imagine you invest all of your money in a single tech stock, and that company has a terrible quarter. The stock price plummets by 30%. Because all your money is tied to that one company, your portfolio takes a huge loss. Now let's say you diversify. Instead of putting your money in one tech stock, you invest across multiple sectors like tech, healthcare, energy, and consumer goods. If the tech stock drops 30%, but your healthcare and energy stocks go up, your losses are balanced out and your portfolio stays more stable. This is the magic of diversification. It doesn't eliminate risk completely, but it spreads it around so no single investment can hurt you too much. Now let's talk about how to diversify your portfolio. There are a few key ways to do this. Firstly, you can invest in different asset classes. Asset classes are broad categories of investments like stocks, bonds, real estate, or cash. Each asset class behaves differently in the market. For example, when stocks are struggling, bonds might perform well, and vice versa. By spreading your money across multiple asset classes, you reduce the chances of your entire portfolio being affected by one bad market event. Secondly, you can diversify within each asset class. If you're investing in stocks, for example, don't just buy shares in one company or even one sector. Look for companies in different industries, regions, and sizes. For example, you might invest in a mix of tech companies, healthcare firms, retail businesses, and international stocks. Thirdly, you can consider index funds or ETFs. These are excellent tools for diversification because they automatically spread your money across dozens or even hundreds of investments. For example, an S&P 500 index fund gives you exposure to 500 of the largest companies in the US, instantly diversifying your portfolio. And finally, you can diversify over time. This strategy is called dollar cost averaging. Instead of investing all your money at once, you invest smaller amounts consistently over time. This helps reduce the impact of market volatility as you're buying at different price points. Now let's talk about why diversification is so important. The main reason is risk reduction. No one can predict the future, and even the best investments come with uncertainty. Diversification ensures that your portfolio isn't overly dependent on the success of a single investment. So here's a quick analogy. Imagine you're a farmer planting crops. If you only plant wheat and there's a drought, you lose everything. But if you plant a variety like wheat, corn, and soybeans, you have a much better chance of getting a good harvest, even if one crop fails. Diversification also helps you stay invested for the long term. If your portfolio is too risky and you experience big losses, you might panic and sell at the worst possible time. A diversified portfolio is less volatile, which can help you stay calm and stick to your investment plan. But here's something to keep in mind. Diversification doesn't guarantee profits or eliminate all risks. If the entire market is down, like during a financial crisis, most investments will take a hit. However, a diversified portfolio will almost always perform better than one that's concentrated in a single investment. So let's recap. Diversification is about spreading your investments across different assets, industries, and regions to reduce risk. It's a key strategy for building a stable, long-term portfolio. The main ways to diversify include investing in different asset classes like stocks, bonds, and real estate, diversifying within asset classes by choosing different sectors and regions, and using index funds or ETFs for automatic diversification. You can also invest consistently over time with dollar cost averaging. And that's it. Diversification explained simply. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out the industryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.